Futures are the best day trading instrument there is. Futures are a contract agreement to buy and sell a specific commodity at a predetermined price and time. An example of this is oil futures, where you're saying, I will buy 100 barrels of oil at $400 a barrel in 3 months. There are also other markets such as the S&P 500 futures that I trade a lot that are just settled in cash. Now that can sound a little daunting. You don't want to have 400 barrels of oil show up at your front door. But when it comes to practically trading futures, all you're doing is really the same thing as buying a stock, of trying to buy it low and sell high for a profit. Because to get those 400 barrels of oil to show up at your house, you actually have to let the contract expire and have all this other stuff go wrong in your favor. In reality, you're never gonna have 400 barrels of oil show up at your front door. All you're gonna be doing is just buying and selling and settling everything by cash. And so it ends up being exactly like buying and selling stock. But why futures are better than trading stocks is because you have way more leverage when it comes to trading futures. What this allows you to do is start trading with a small account. You can start trading futures with $1,000 compared to with stocks. To get actual movements of money in the market, you have to have a lot of money to start with, and not everyone can do that. Now, if you have looked into day trading stocks, you will have heard the pattern day trading rule. And so all this rule basically does is it doesn't allow you to day trade consistently unless you have over $25,000 in your account. And futures, they do not have this rule. And so with a small account like $1,000, you can make as many day trades as you want, allowing you to start with a really small account and day trade whatever strategy you want. And so the futures market I'm gonna focus on in this video is the S&P 500 futures. Now this is the futures for the S&P 500 index, which makes it the most liquid and tradable market. And so if you're looking to start trading futures, I would highly suggest starting with this market. Now, when it comes to buying a futures contract, think of it like buying one share of a stock. In practicality sense, when you buy a contract, it goes up, you make money, and when it goes down, you lose money. And all the difference is that you're buying with something called margin. And all margin is think of it like collateral. You're putting up a certain amount of money to gain control of this contract. And then as you hold that contract, it'll go up and down in value, increasing or decreasing your account. Now, there's a few different things with margin. Because futures trade 24 hours a day, you have something called intraday margin and overnight margin. Now, generally the stock market as a whole trades from 9:30 Eastern Standard Time to 4 o'clock Eastern Standard Time. During that time, futures are considered intraday. And so the margin requirements for that can be a lot smaller. Generally, it's around, at the base, it's 7,000 or 8,000 for the ES or S&P 500 futures. And then the overnight margin can be double that. And so 7,000 or 8,000 for one contract is still a lot of money. And what a lot of brokerages have is something called low margin requirements. So for one contract of the ES futures in intraday, you can get requirements as little as $500 per contract. And so this allows you to trade with that small account that we were talking about. Some good platforms that do this are NinjaTrader or Tradovate. And what they do is they just allow you to trade futures with that low margin requirement, and their account minimums are very low, allowing you to easily get access to trading futures. Now, another big difference between futures and stocks is stocks trade on a dollar basis. So if you have $1,000 stock and it goes up $1 and you have one share, you've made $1. But with futures, they have what is called a tick and a point. Now, a tick is the smallest amount of movement that the market can move. And so with shares, usually this is 1 penny. Usually the stock can go up pennies at a time at a minimum, or even more. But with futures, they have different increments. So one could be 0.25 or one could be 0.1. Now with the ES futures, the minimum movement or the tick value is 0.25, and a point is 1. So a tick is essentially a quarter of a point. And so you can see when you're actually looking at the market move in real time, it is going up and down in 1 tick increments, or 0.25 or a quarter of a point. And so because of this, they are not valued at $1. Each different futures commodity has a different tick value. So for the ES, one tick or the smallest price movement it has is $12.50. And so a point is worth $50. And so this is where you actually see the leverage that the market has. In reality, all you need is $500 to start getting movement on one futures contract. And in general, in just a few minutes, the ES can move up 10 points. That is $500 in just a few minutes. And so you can start to really see the leverage that you can get with these contracts. Now, if that's too much leverage to deal with, what futures have is something called the micro futures. And what this is it's a contract of the same commodity. So for the S&P 500 futures, you're still trading the same thing, but it is 1/10 of the size. The ticker symbol for the S&P 500 futures is ES, and the ticker symbol for the micro smaller version is MES. And so this 1 point is worth $5, and the margin requirement is also $50. And so you can trade extremely small account size by doing this. And again, it allows you to start really, really small. And then of course, it is really easy to scale up your account as you start to grow it, because all you have to do is buy more contracts. And because the ES futures is the biggest, most liquid market in the world, you are never going to have a problem with trading as many contracts as you want. Now, when it comes to actually trading futures, it is best to day trade them using technical analysis. And what I've actually found over years is the most profitable way of doing this is looking for reversals in the market. Now, a lot of times you'll hear that the trend is your friend, but what I have found is that reversals give you a lot higher risk reward. You don't have to be right very often, but when you do, you get paid really well for it, making you profitable in the long run. Trading isn't about being right every time. It's about consistently making money over many trades. And when you have a good risk reward ratio, like risking 1 to make 3, you only have to be right a third of the time to be break even. And if you're right half the time, you are profitable. And reversal trades do that very well. But to do it consistently and profitable to where you're not just reversing randomly in a strong trend, there is a powerful checklist that I have found to help find these opportunities. Now, the first one of these is top-down analysis. What you want to be doing is looking at multiple time frames. You want to be looking at a larger time frame for the trend and the overall structure of the market, and then zoom into a smaller time frame to actually enter in on the trade. And so for me, I look at a 15-minute chart for looking to where the support and resistance are, and then I zoom into a 1-minute chart to actually enter in on the trade. I like to draw support and resistance zones based on what the market is telling me. And so what I mean by that is you can see these highs up here where the market has topped a couple times. I just like drawing off of those and dragging it to the right and seeing where the market bounces off of that. And so as the market comes up to this level and bounces off up here, there's probably a high likelihood that the market's going to reverse off of here. And then once it gets to that area in real time, I jump into a 1-minute chart and look for a few specific patterns to get in on a trade. Now, that's the awesome thing about futures is you can bet the market's going to go up and make money, and you can also bet that the market's going to go down and make money that way as well, if you can find the right spot. And so that is the number one thing, is we want to see the market get to our resistance area, or our area of high probability that the market is going to reverse. Because a big mistake a lot of people make when they're trading is having the mindset of always be in the market. They want to spot every move in the market and try and profit from it, instead of just looking at key areas in the market and consistently profiting off of one pattern and being patient until that pattern shows up. Then once we see the market get up to that level, the number one thing when counter trend trading is you have to make sure that that uptrend is broken, because you don't want to be trying to bet that the market is going to go lower in any of the pullbacks that the market has, when it's just, that's a normal pullback in the market and it's just going to keep going higher. And so what we need to be looking for is a nice support level that the market has confirmed and it's bouncing off of, and you want that to be broken. Because that is a big key that, hey, the market is breaking its uptrend, and that's adding on to the strength of a potential reversal. That is all these are doing, is it's stacking on top of each other, things that increase the probability that the market is going to go down. Number one is that resistance. Number two is that break of our downtrend. And then what I found that really increases the likelihood of the market reversing is waiting for the market to make a pullback that gets rejected in the market. Essentially, all it's doing is making a lower high than the previous one, showing you that the market is done making higher highs, and it could start shifting into lower lows and lower highs, which is a downtrend. And that's what you want to be looking for when you're counter trend trading. And then the final thing is a candlestick pattern. There's a lot of different candlestick patterns that you can use. Now, my favorite one is some kind of engulfing candle. What you can see with these 3 or 4 candlesticks is the market kind of was moving up slowly, and then all of a sudden it just ripped back lower, closing below the last candlestick and almost the one before that. It's a massive red candle showing you that there is big sellers coming into play, and it has started to make the potential of that swing back lower. And so as it finishes, I like to get in on the close of this candlestick. When you're trading, you want to wait for the candlestick to finish forming. So if you're on a 1-minute chart, make sure you have a timer somewhere that shows you how long until the candle is formed. And then when you see that coming to an end, then jump in on a trade. Then there's a few different types of orders you can use. You can use a limit order, which just gets you in at an exact price. So let's say if I want to get in exactly at 37.39, if the price hits that and it fills me, I will get in on a trade, betting that the market's going to go lower. But if the market moves too quickly and blows past that order, I might not get filled. With the market order, if you put it in at 37.39, it could move down and fill you at 37.38. Now, that's not a big deal in the big picture when you're looking for the market to give a massive reversal back lower. And so use whichever one you find that works best for you. Now, let me show you what it's like to actually trade futures in real time. And so I trade this strategy that I just showed you every day. All I do is look for those patterns every day. And if you can see here, we have our uptrend that is starting to break. And then up here is that resistance zone from a higher time frame. And then the last thing we look for is some kind of reversal pattern or large rejection bar. And so right here, this current massive bar that's going crazy, you can see it punches higher and then punches back lower. And that is a really good signal, because if you read a little bit more in the candlestick of what it's telling you is just analyze what the chart's doing here. We see the markets going up, going up, going up, sitting around, chopping a little, makes a massive attempt to go higher and gets reversed on. And so that's a really strong key to go back lower. And so I got in on that. You can see here is the current amount I'm up. And then I put my stop loss above the extreme of that high, because you want to have your stop loss protected by the structure of the market. That is the biggest thing about technical analysis, is understanding, hey, we're in an uptrend. And if it decides to go lower, it's going to make lower lows and lower highs. But if it keeps going up, it's just going to continue breaking those highs. And so that is the whole idea of having that stop loss up there initially, is that if that high gets broken, hey, we're wrong. The market's actually going to continue higher, and that's totally okay. Now, for me, I like to manage these trades more aggressively. And so I actually moved my stop to break even here as the market started to move lower in my favor. I like to capture some of those profits. Now, I would suggest having a more fixed profit target when you first start out, but as you get better and better at trading, you can add on managing the trade. And so once the market gets going and I've moved it to break even, I then like to move it down with the pullbacks. And so here you can see we had a pullback, and I put my stop above that, because again, going with the idea of trading with the trend and sticking with the trend, I'm going to only move my stop loss down with those swings to stay with it. Now, when it comes to trading, I only trade a couple hours in the day. The futures do trade about 24/7, but the first few hours in the day are generally the best in terms of volatility and potential profit in the market. Now you can see the market had a little pullback here, and I moved the stop down again. And I actually have a video that talks more about trailing stops and how to use those if you're interested in that. And the leverage is what allows you to really use this as a beginner. And then a big thing here as well is you can see I have a support zone from a larger time frame down here. And of course, what are we going to expect down there? The market's probably going to reverse up. And so because I'm in a trade betting that the market's going to go down, I want to be aware of that and get out of the trade once it gets close to that. And so here we can see that the market is in a really tight downtrend. And once it breaks that, I want to look to get out of the trade, because the same thing with up here, the market broke this at our resistance level. Well, if we have a downtrend down here into our support level and it breaks that, it's likely that the market will find support here. And I want to just get out of my trade and take my profits and run. And so here you can see we were starting to get strong bullish bars here. And as we make kind of the final pullback in this move down, I'm going to move my stop loss down above those candles, because if the market decides to, of course, continue back lower and keep going, that's great. If not, I can close out right here up about $600. And that is a great, great trade to profit from. And looking forward, so you can see the market pretty much bottomed right there. Now, if you want to learn more about this strategy in futures, check out this video right here. And if you want to just learn everything I know about trading, I do have a course that I link in the description below.